So again, if we look at any market, we can say that it moves in some kind of higher highs and higher lows, or if bearish, vice versa. Yeah. And why it happens so? So we will not go too deep into the theory, but overall, we need to understand that there are some kind of big participants in the market, and they want to be in profit. Okay, so how can they be in profit? If the market will move like this forever, they will not be in profit. So that's why if they can push the market and create new points of liquidity, how we call them, we will come back. Everything like that you don't understand right away, just skip it. Okay, we will discuss it more. But how do you think? Who is buying here? So the market went like this, made some kind of a high, and now made a retracement. Okay, so someone is buying here. Yeah, and what did someone, this composite man, the big institution, smart money, what they want to do? They want to profit. And if they want to profit, they need to push the prices from here. They want to push them somewhere here and then take their profits. So that's why if they are positioned here, we say, okay, now they need to push the price above this point. Okay, now they now the market can make some kind of a retracement, and maybe they will position themselves even more here and then push the market as well once again and break the next point. They will position themselves and break and reach their final target. Okay, this is like really simplistic concept. We will, if we will go now into more details, it will be like really confusing, because for instance, what you need to understand that they are not trading like us. I mean, I'm not referring to specific institutions or anything. It's just the nature of the market that there are strong hands and weak hands. So there are some kind of entity, some kind of overall number of participants, a group, and they are not even connected with each other. Yeah, there are some market makers, but overall there is weak part and there is strong part. And strong part in the market, they are positioned here, but also they are positioned here, and they are trading like, I mean, it's the nature of moves, yeah. So they are trading in two directions simultaneously at the same time in different time frames. But overall, if market is doing something like this, we know that they want to push the price higher, and overall they are bullish. So their main positions are bullish, and they need to come to whatever zone they want. Okay, so this is like this is just a general talk now. Okay, we will not trade these concepts. We will trade specifically the mechanical part that I started to show you, but now I just want to talk in more details about the theory behind. Yeah, so now we know. Okay, so this is the nature of market, that it wants to hold some kind of structure, and now we say, okay, if they are positioned here, and remember I told you, if they want good prices, they will push the market lower. So again, I'm telling they will push the market lower, but we don't need to understand specifically how they do it. It can just happen because the market moves like this. Yeah, the market moves to cheaper prices, then strong hands come into the market, position themselves, and go away. But remember, I told you that they are trading in different directions at the same time. So what they will do here is they will sell as well. Remember, they are bullish overall, but they will sell to buy. And now their selling orders are in negative, of course, because they sold, but they are capable of holding them how much time they want. And they sold here. Now they are in drawdown. That's why we see a retracement. We see a retracement to demand zone. They close their positions. Again, it's very simplistic way that I'm telling now, okay? It's just a concept. So they're closing their negative positions at break even, and then they continue the move. They sold here, and now they have negative positions here. They come back. They mitigate the demand zone, the last down push before the up move. They position themselves again and move the price higher. So that's why we call these points protected lows and protected highs. Why? I mean, protected lows in the bullish market and protected highs in bearish market. Why? Because we assume that if the market is bullish and if the smart money, they want to keep the market bullish, they don't want to go below these points. Okay, they don't want to go because they will be in negative now from their overall buying positions that they were here, and so on. Okay, so this is the concept of higher highs, higher lows, and like a bit about smart money. Again, if this is confusing, like totally, send me a message like, Dima, I'm like confused as hell. Okay, but again, this is just a simple idea of this. Then remember, I told you that of course market will not move perfectly. So what he will do instead? He will do some kind of moves before moving higher. Why it happens? Because they create liquidity. Yeah, liquidity is just a bunch of orders, like many orders. So when a market does something like this, a lot of people and institutions and banks, weak part, will start to buy here, and they will have their stop losses here. And then strong hands will use this liquidity for their purpose, and maybe even to create more highs and lows intermediary. So just to manipulate the market and collect the orders. Why? Because when they come to this point, to real demand zone, they need a lot of orders to fill their buys. Because if someone is buying here, they need to have sellers. Okay, so strong hands will buy here, weak hands will sell here, and all of the purpose of these moves is just to create this liquidity. And now they have their orders filled, and then they can move the price higher. Okay, so that's why we say that there is some kind of a push, and then market starts to create this fake structure, yeah, or intermediary structure, just to confuse everyone and just to create more liquidity. Again, we are not trading this. We are not thinking, oh, the smart money came here into the market, they confused everyone, and now they will have this manipulation and that manipulation. We are not actually trading that. We are trading the pattern that is objective, that is in the market, and that's all we trade. Okay, we trade mechanical part, but this is some kind of theory behind it. So so when the market will move, it will move not perfectly, but like this, and then create a push. And now we need to understand where is our protected low and protected highs, and where is our supply and demand zones. Remember, we said this is a protected low, and this is a protected low. And so the question, people will start to confuse themselves, and that's why we need this rule about the pullback, that we actually, now we are like slowly coming to the same question we discussed during the first session. That's how to know if the low is protected or if it's just an intermediate low and we don't want to use it. That's why we came with a rule that that we decided, okay, And by the way, there are some different variations how to look at it. But because we need to find a consistent pattern that we can use in the same way over and over again, that's why we made a rule that, okay, if we have some kind of a high, and when the market breaks this high with one move, okay, one impulse, now we have, and then starts a retracement. Now we say, okay, this will be our new high, and this will be our new low. And this is one impulse that is telling us strong hands came into the market from here. So they made their last push, their last manipulation at this part. So this is a down move before this up push. And now we say, okay, our new protected low is not here, is not like here, but at specifically at this place, because we know that the push started from here and we want to use it as a new impulse, new footprint, a new representation of strong hands coming into the market. And that's why there is this idea about a true range, and fake structure. Okay, so that's approximately and very basically where it comes from. And we need to take a step even further and decide where we will what move we will look at as one move. So is this a one move, or is this a one move, or is this a one move? You see what I'm talking about? So if you don't have a rule, you can say to me, but Dima, this is one push. Yeah, kind of. On a higher time frame, yeah, this is one push. That's when this rule of pullback comes into play, and we start to say that if this is our high, and this is a break, we decided that we will use a pullback rule to separate like one move from and the end of that move. That's why we say, okay, as long as we will not have any candle close below the previous one, we will not count this as pullback, and we will consider it as one move. So imagine that this candle didn't close below this one. So for me, in this case, this will be one push on this specific time frame. Okay, I'm not talking about many time frames now. We will talk about it later. So because of that, if imagine this candle didn't close below that one, and no candle closed below the previous one. So why we say that it's important? Because in fact this is a break of structure, yeah. Because if on a lower time frame, and this is some kind of fractal concept, so we can actually understand what happens on lower time frames looking at candles. On lower time frames, the price went here and then went down and then closed below this low. So we say, okay, for us, this is a significant change in order flow in the market, and it's time to separate the move. So this is the end of our new impulse. So the impulse is one move. We don't look at these candles as a part of something different. For us, this is still one move. And we just use this rule to present a mechanical part of this system, okay? Because what we need to actually trade, here is the problem, yeah? People, when they come into the market, they will be really subjective. Someone will trace the structure like this, and he will be correct. And now someone will trace the structure like this. So he will use more details, and he will be correct as well. But my question now, okay, you know the concepts and you know how the market moves. So now you expect the market to break this high, okay? But how will you trade it? Will you trade this, or will you trade like this? I mean, where is your foundation? Where is your boundaries? Okay, where is your pattern? And that's why we need to have these. We need to have impulses and ranges set in stone, and we need to have a way for actual trading to separate ranges in the same manner over and over again. That's why this pullback rule started, and we said, okay, anytime the candle closes below the previous one, we will count it as a pullback, so the end of this range and possibly the start of new range. Yeah. So now I will comment on new part of your homework. So what you actually will do, and by the way, you need to understand, of course, that when the market is moving, he is creating bigger pushes. Again, now I'm coming back again to general concepts. So just a general talk. Of course, market is moving like this. So we have these bigger pushes, okay? And people know about this, but I tell you, like, not many people will actually go to the market and see how it goes, yeah, and see how it goes. But if we have this big structure, and again we see that there are a lot of pullbacks here and retracements and a lot of new structure, but on a higher time frame. So let's look on monthly, for instance. You see, on a higher time frame, these are all clean moves. These are all clean moves. So again, this is just general concept of structure within structure. And if you're looking for something like this, you know that inside your moves, you have new structure, intermediary structure, yeah, that can shift. So we have a bullish push and bullish intermediary structure, which can shift bearish, which then can shift again bullish, and bearish and bullish and so on. And if we zoom in, we can say, okay, we now have these huge pushes, we have these small pushes, and we have even inside these smaller fluctuations that we understand that on the lower time frames, they are ranges in themselves. So there are like three kind of structure, yeah, like big institutional structure, inside structure, and even fractal structure. But it does not matter for actual trading. This is all just theory, okay? I'm just like talking about everything a bit, so you get used to this idea of how we can view the market with the structure. And yeah, so basically what you can do before even doing the actual ranges, and again, sorry, I will come back again. When a person understands all of this, and he knows that market will move like this, and even more structure inside. Again, you understand this, okay, but how will you trade it? Where is your rule? That's why we need to make these steps and have some rules for defining ranges, separate ranges on a given time frame. And then later we'll use multi-time frame analysis and yeah, and have a better context for our trading. So now what you can do, again, just to train your eyes, and this part, please pay attention, this part will not, it's not like we trade, okay? It's just to see how market moves, because the important rule is if a market does something like this, we expect the continuation, okay? We expect the continuation, and that's why you can just use your eyes and just trace, so you can do it and record the video as well, and just trace how price moves. So you can tell, okay, overall we have this huge push, so somewhere from here to here. Again, we are not trading this. This is not a part of mechanical part of our strategy. We just see how price moves. So we have this kind of one push, we say. Okay, and then price. And so we say, okay, if this is one push, now we expect the market eventually to break this point. Yeah, because we know that if strong hands wants to profit, they need to push prices higher. And by the way, as you see, the market actually held it. So we have a new point and then new point. So now we have this two huge pushes. Now you can tell, okay, but what happened inside this bigger moves? And yeah, just to repeat, this is something that you need to do as part of your homework. So you need to see the market, that it went this big move and this big move and this huge retracement. Yeah, and this huge retracement. So again, if we switch to monthly, you see this is like move, retracement, move. Okay, but let's go back to daily. Again, now you had three moves. Let's go inside. So what can we see? We can see, okay, we have a move, a push, bigger retracement, push, retracement, push. So actually at this place, we see that there was this bigger push, but bearish push inside. And then structure shifted back on internal basis. Now retracement started, and again we see a lot of shifts of structure here. So many moves like this, but as you can see, the structure holds. So we have bearish push, and now we expect this impulse to hold. We have a bearish push, we expect this to hold. We have a bearish push, we expected this to hold, didn't hold. We have bullish push, expect this to hold, didn't hold. We have huge bullish push. Now we have this structure, yeah, and now we can go even further and understand that all these candles are responsible for their own impulses and retracements on lower time frames. And what we can do is trace it like it goes. You see, up move, down move, up move, down move, up move, down move, up move. So you see how it holds. Up push, so now we have this push, it holds. We have this push, holds, push, holds, push, holds, didn't hold. Now we expect bearish. Again, it's not a part of strategy. We are just discussing the general structure of the market. But we need to do it. We need to actually do it because we need to see and train our eyes to see these moves in the market. Because if you just, by the way, okay, let's continue. And like this, so push, up, down, push, and so on. And so you see, if I'm just switching off the price, we have our our usual schematic for market moves. So we have a range, we have internal structure, we have a tap into demand zone, and we have a new range. Okay, so this will be your homework. I mean, not all, it will be a new part of your homework. Again, send me any questions, let's discuss further, but I hope this talk was somewhat helpful to you.